A warm welcome to you, my dear children. We meet again with the latter part of Unit 6. We started Unit 6 several sessions back and we have continued up to this point. And in this session, you're going to practice even more. You're going to practice further how the double entry accounts are prepared, which means you're going to prepare more double entry accounts, recording more transactions in debits and credits. This is something that most of the children face a difficulty with. With debits and credits, most of the children face some sort of a difficulty at the very beginning. But as we move ahead, you are going to practice with me, and practice will make you perfect. All right. Having said that, children, I want to draw your attention on the screen. I have included this slide here to better demonstrate the debits and credits and how they happen. How debits and credits happen. All right. In the previous several sessions, actually the one before this session, I brought to you the double entry principle. The double entry principle. And I told you that double entry principle is something that you will be using for the rest of your lives if you continue to become an accountant or to any profession related to accounting and finance. Right? Bookkeeping, basically. In the basic level of bookkeeping. From that level, you will be using the double entry principle. The double entry knowledge is very important. Right? It will save your life in some cases. So, let me get your attention back to the double entry principle. This is what we discussed in the previous session. Right? It says, due to transactions, the increasing and decreasing of values of assets, equity, liabilities, income and expenses are entered in ledger accounts according to the double entry principle. And this is the double entry principle. This is that principle. Okay. According to this only, you decide the transaction amount, whether to record it in the debit side or whether to record it in the credit side of an account. All right. That is better shown here. It's better shown here. Get what I'm saying? Yeah. Let's look at how it has been organized, huh? Right. We have assets here. Assets equals to liabilities plus capital. We say capital or we say equity. Whatever it is, it's the same. Assets equals liabilities plus capital or capital plus liabilities. It's the same. Right? Now, as you can see very clearly, children, we have assets increasing right below, and I have shown you that assets increasing are debited. Assets increasing are debits always. Can you see this? Yeah. Assets increasing are debits always. Next, I have under assets, decreasings. Asset decreasings are credits always. Always assets decreasings are credits. Alright. So if we focus on decreasing of assets, you have to memorize that decreasings of assets are always credited. If an asset value decreases, it always goes to the credit side. And if an asset value increases, it always goes to the which side? Debit side. Okay. All right, now something you should picture in your mind. This is not something that you can argue about. It's a rule. Okay, it's a theory, it's a rule. Every time some sort of an asset increases in value, which means, for an example, if we buy new furniture to the business, if we buy and bring new furniture to the business, the furniture asset increases. It increases. So then the furniture account always will be debited with that amount. Let's say that the new furniture was bought into the business and that new furniture is worth 50,000, which means that 50,000 should go to which side of the furniture account? New furniture bought, right? So in the business, furniture asset increased, and you know that asset increases are always debit. That means that 50,000 of furniture should go to the which side? Debit side of the furniture account. Simple, right? Yeah, there's nothing to it. You just remember asset increases are always debit and asset decreases are always credit. Well, to show that, if you take the same example, buying new furniture for the use of the business, the furniture asset in the business, the furniture which is in the business, has increased because of this transaction. But at the same time, for the furniture, if you paid by cash for the furniture, if you paid cash asset in the business has decreased. At the same time, furniture increased and cash decreased, which means cash asset decreased. Now you know to which side of the cash account that 50,000 should go. Decreasing assets should go to the credit side. It's good. All good, right? Likewise, children, liabilities, children, when liabilities decrease only, it gets to debit side. When liabilities decrease only, liability decreases, debits. Liability decreases and it should go to the debit of that account. If liability increases, then that's a credit. The opposite of assets. The rule is opposite. Equity also, it's the same. Increasing credit, right? decreasings, debit. Increasings, credit. Decreasings of equity is always debits. Can you remember this now? Can you? If you can't remember, if it is too hard for you to remember, I have even included this. Here is something that can be useful to you. Take a look at it. If you draw a square, divide the square into 4 boxes, right? In this big box, you have 4 small boxes. Assets and liabilities on top, expenses and income in the bottom. Now, as you must have noticed, there are 2 more items, expenses and incomes. Right? I'll make it easy for you. Expenses couple up with assets. Expenses couple up with assets. Couple up. That means they are on the same side. Right? When assets are increasing, those asset accounts are debited. Same for expenses too. When expenses are increasing, those expense accounts are debited. Alright. So these are the debits. Assets and expenses. No liabilities, no equity here on this side. Only expenses couple up with assets. Both of them, assets and expenses, both of them, they act the same way. They act in the same way. Increasings always debited, decreasings always credited. Okay. Increasings always debited, decreasings always credited. Right. And in the opposite side, we have liabilities, equity. Liabilities, let's say capital. Liabilities, capital and incomes. There you go. This is the opposite. They act in the opposite way to assets and expenses. They act in the opposite way. Right? Liabilities and capital, when they increase, they are credited. Liabilities, liability accounts, as they have shown here, liability accounts are credited when they are increasing. Same for capital also. Capital accounts are credited when capital increases. And incomes also the same. Incomes also the same. When incomes are increasing, those income accounts are credited. Income accounts are credited. Right. Okay, that's it. So what you should remember here is assets and expenses are on one side, all right. Liabilities, equity and incomes are on the other side. Assets, expenses, capital, liabilities and incomes. Opposite sides. These guys increasing debit, these guys increasing credit. Is it confusing? I don't think so. All right. That's it. Moving on. We have some activity on the screen, which is from the textbook. Let's do this. Let's do it now. Let's read the activity first. Write whether the increasing and decreasing of each of the following accounts should be written in the debit or credit. They have given some accounts. See, building account, bank loan account, sales account, electricity, interest received. It goes on. The list goes on. And they're asking when they increase, should be debit or credit, and when they decrease, whether they should be debit or credit. Simple question. Shall we do it? All right, together. First, we have the building account. Building account. And when buildings increase in value. For an example, if the business has purchased a new building, if the business has purchased a new premises, land and a building, it's a big value. So building asset has increased in the business. Should it be credited when increasing? Credit or what? And when decreasing, what? You should be able to figure it out. I'll help you with the very first few. Let's see. When building account, you have the building account with you, and if the building value has increased, what should you think of now? What should you think of? First, you should think of whether this account is an asset account, or whether it's a liability account, or whether it's an expense account, or an income account, or a capital account. What type of an account is this? What type of an account is this? First, you should decide that. Now tell me, building account is an asset account, or is it a liability account, or is it an expense account? What is that? Income? I don't think so. No, children, no. It's not an income account. It's not a liability account. It is an asset account. So first I will write it here. It is an asset account. And when assets increase, you know which side. It's right here. When assets increasing, debited. Remember the rule. That is the rule. What should we write on this column? Increases, debit. Then obviously decreasing is the opposite side, which is credit. Simply you can figure out one end and the other end is, it comes automatically. If you know increasings are debit, obviously, definitely decreasings are credit. There's only two sides. It's not rocket science. Just figure out which side. Okay. Bank loan account. What type of an account is the bank loan account? What type of an account is it? Asset? No. Somebody said liability. That's correct. Liability. It is a liability. It is a liability account. And liability is increasing. Well, there's nothing to think about. There's nothing to think about. The answer is on top. If assets increasing are debited, liabilities are the opposite. Liability increasing are credited. They are always credit. Then of course decreasing are debit. Simple, right? Yeah. Let's figure out the third one. What type of an account is sales account? Selling goods. You are selling goods. Goods. Stock. More and more goods. When they are sold to customers, you get an income. Selling is an income. So sales account is an income account. Let's see the double entry rule for incomes. Incomes are here on the liability side. Increasing credit, then decreasing are obviously debit. Right? Incomes are with liabilities. Increasing are credits. Increasing are credits. Always credited. Then we can write increasing credit, which means decreasing, simply we can say decreasing are debit. There's nothing to it, right? Nothing to it. So let's finish it off. Electricity charges. What type of an account is electricity account? Always paying. Every month you have to pay. Every month, every year, electricity bill never stops coming. And you never stop spending for the bills. Bills are always expenses. Right, so expenses. Expenses. And you know that assets and expenses are on the same side. Increasing debit, assets and expenses. This is an expense, this is an asset, so on the same side. Increasing is always debit. Decreasing, what are you thinking? If increasing are debit, decreasing are obviously credit. Two sides only. Moving on. Interest received account. What do you think? We are receiving interest from the bank for our deposits. The bank pays us interest. Money comes in as interest. You know what interest is, right? Don't tell me that you don't know what interest is. Poly. If you take bank loans, you have to pay the bank interest. But if you have deposited your money, if you have deposits, you receive interest from the bank. Right? You receive interest from the bank. This is such a case. Interest received. Income, right? Of course. Incomes. And you know by now the incomes are coupled with liabilities, capital and liabilities. I mean, incomes act the same as capital and liabilities. That means increasing credit. Then obviously decreasing must be debit. There's nothing to think even. If increasing are credit, decreasing are obviously debit. Don't have to say it all the time, right? Yeah. So vehicle account, we are moving on with this question. Vehicle account is an asset account. It is an asset account. Assets are always increasing debit. Then decreasing credit. Purchases account. I'll give you this one. What do you say? Purchases account? What type of an account is purchases account? This is for you. Is it an asset account? Purchases account. It's here. Purchases. Is it a liability account? No. Then what? Is it an income account? Purchases. You know, we pay money to purchase goods for the business. Pay money to purchase goods. Money goes out. Expense account. That's right. Good thinking. Expense account. It is an expense account. That's right. Okay. It's an expense account. Then expenses act the same as assets. So increasing debit. I'm going to write DR only. And for credit, I'm going to write CR. Last one? No, we have some more. Capital account. Oh, capital. First time we are having a capital account in this exercise, yeah? Yeah. Capital account is obviously it is capital. And capital is together with liabilities. Not sure? There you go. Capital is with liabilities. Increasing credit, right? See? Increasing credit. Remember the double entry principle, huh? Increasing credit. Alright, only the CR. Then decreasing debit. We have drawings account next. Drawings account is it's a capital account. Most probably these two are the only capital accounts that you will get, children. Only these two capital accounts you will get in your O-level days. You know what I mean? In your O-level days. For capital accounts, you will get the capital account and the drawings account. Only these two. Okay. But drawings account acts differently. Remember, drawings increasing is a debit. Drawings account is always increasing a debit. There's a problem there. A slight problem, a small issue. Although drawings account and capital account are both considered as, the type is considered as capital, this account and this account both are capital accounts. There are 5 types now, 5 types of accounts. There are asset accounts, there are liability accounts and capital accounts. And yeah, there are asset accounts, liability accounts, capital accounts, and somebody said income and expenses. And that's right. Income and expense accounts. Assets, liabilities, capital, incomes and expenses. These are the 5 types of accounts. Out of these 5 types, capital account it belongs to what? Capital account is a capital account. Okay. Drawings account is also a capital account. But there is an exception here. Capital accounts are increasing credit. Capital accounts are increasing credits. Increasing capital accounts, increasing the credit. The problem is the drawing account acts differently. It acts differently. Increasing debit. Remember that. And we have finally the debtors account. The debtors account. Debtors accounts are, common in any business. There are debtors accounts. There is not one. There can be many debtors in any business, because when the business is selling goods on credit, it's a credit transaction. Debtors are created, and for each debtor, one account is created. Like Sumanasiri account, Piyadasa account, Charita account, Asanka account, Udesh account, Madhuka account. Yeah. Vikramaratna Stores account. In that case, Vikramaratna Stores is a debtor. You get it? That shop, that Vikramaratna Stores has bought goods from your business, and they haven't paid money yet. So Vikramaratna people, the Vikramaratna Stores, owns our business. That makes them debtors. Likewise, there are various debtors. Okay. All right. Debtors accounts are asset accounts, and assets increasing debit, decreasing credit. There you go, children. Activity done. Okay. This activity is from your textbook, so you can do it even at home without watching. Try to do it alone. Figure out the debits and credits. I'm sure you'll be able to do it. Just remember the double entry rule. Assets and expenses are on one side. Capital liabilities and income are on the other side. Increasing debit, but capital liabilities and incomes increasing credit. Shall we move on? We have a lot of transactions to record. Let's record double entries of transactions in ledger accounts. That's what we're going to do now. All right, children, we have another demonstration of debits and credits. Assets increase, decrease, liabilities decrease, increase, decrease, increase. Let's get to it without further delay. Moving on to record transactions in double entry accounts. The debit credit game is going to start now. Well, I'm going to give you an easy method just for your use. Read out, children. This is an easy method that you can use in the beginning, but you can't go ahead further, like when you go into complex accounting practices. No, but this is good for beginners, just to figure out how debits and credits come, to decide whether it's a debit or a credit. Let's read out. A useful hint in deciding on which side of the account the item should be entered. All right. It's called the in and out approach. How nice. In and out approach. It's called the in and out approach. A useful hint in deciding on which side of each account the item or the amount should be entered is to think of the debit side being in. Okay, right. That's interesting, huh? Debit side, you think of it as in. All the ins go to the debit. Well, let's try it out. It's easy if you can do the debits this way. You think that all the coming ins, cash in, and with the other assets in, van or equipment or machinery is coming in, goods coming in, all ins are debit. Debit side being the in, all right, and the credit side being out. Credit is the out. Fine, that seems easy. Okay, let's see whether we can do this first. You consider debits as ins, or you consider ins all, asset or whatever, cash or goods or into the business are always in the debit side, and out from the business are always on the credit side. Okay, two examples using this approach, using this system, are shown below. Let's see. Example 1. Paid cash rupees 3,000 to buy second-hand van. A regular transaction. A business has paid cash 3,000, okay, and bought a second-hand van, maybe for deliveries. That means 3,000 cash, 3,000 goes out. Van comes in, right? Cash 3,000 goes out. Van comes in. So ins are debited, see, which means van comes in and van account must have a debit entry. Wow, that is easy, right? Of course, yes. Van comes in, so it's a debit entry in the van account. Okay. And since the cash went out, 3,000 cash went out, outs are credited. Tell me which account should be now credited? The answer is there. Cash account should be credited. Yeah, that's what they say. Alright, children, this is from a very internationally accepted method from a easy method from a book. If you want, you can use this. All right. Cash goes out. So it's a credit entry in the cash account. Any more? Example 2. Took 500 out of the cash in hand of the business and paid it into the business's bank account. That means 500 cash out of the cash till, the cash till, cashier, out of the cash till 500 has been taken out, and that 500 goes out of the business. Then outs are credited, right? Oh yeah. And since outs are credited, yeah. Outs are credited. And since the bank account the business bank account, gets the money coming into the bank account, the bank account increasing, and it's a debit. Yeah. Well, you can use this method, children, if you want. It's an easy method. The double entry for this transaction would be as follows: money, cash, credit, bank, debit. Cash, credit, bank, debit. Let's see the double entry with accounts. Okay. Here we have another example. Bought goods for resale. It's a grocery shop or it's a hardware store. They are buying goods from the suppliers. They are buying goods, stock or goods, buying from the suppliers to the business. And the goods are resold to the customers. That's what they say. They are retailers. In such a retail business, they have bought goods for resale. Okay. Paying by cash. That means they have paid cash for the goods. Cash 5,000 goes out. Okay. 5,000 goes out. Goods come in to the business. Let's see how this transaction is recorded. Goods bought for resale are recorded in purchasers account. Something that I wanted to emphasize, something I wanted to highlight. Children, when we buy goods, when purchases are made, but remember, goods for resale, not other assets. When we pay for the goods, and when we buy goods from our suppliers, when we buy goods from our suppliers, stocks of goods, boxes and boxes and boxes, or sacks and lorries filled with goods, when they come to our shops, we buy from those lorries, the suppliers. Maybe you have seen loading and unloading goods to shops. Those type of purchases should be recorded in an account called Purchasers Account. Something that should be highlighted. Goods bought for resale are recorded in a Purchasers Account. Likewise, children, when goods are bought, when goods, stocks of goods are bought into the business for reselling to customers, those are called purchases. But if you buy something else, like if you buy a machine, right, or equipments for the use of the business, or if you buy a motor vehicle, like a bike, to be used in the business for delivery purposes, those are for using, not for reselling. Those are assets which are bought for using. Those assets, even if you purchase, those transactions are not considered as purchases, or those values, let's say bought a bike, a delivery bike for 100,000. That should not be recorded in purchases. Only when goods are bought, goods for resale. Only when goods are bought for resale. Alright. These go to purchasers account. Purchasers account. Right. Then check the in and out approach. That's what we have been talking about. In and out approach increases the asset of purchases. That means goods come in. No, this is out. No. Goods come into the business. Goods, more and more and more. Boxes, stacks, stocks. Stacks of boxes or sacks or whatever. A big stock come into the business, right? In goes to the debit. Remember? In goes to debit. Well, we marked it here. Debit in, credit out. Okay. Likewise, we will consider the goods coming in as a debit entry. See? Okay. Debit to the purchasers account. In to debit side. And out goes the cash because we have to pay for the goods that we purchased. So out goes the cash. Out into the credit side. So out what? Out is cash. Out what? Going out is cash. So out is cash. So cash account, credit side. Debit to the purchaser's account, credit to the cash account. Because cash goes out. Well, it's easy to remember that way, children. I don't know whether you are already using the double entry system. If you are using the double entry system, if you can remember the double entry principle, increase debit, decrease credit, no need to change to this system again. But the beginners, for you beginners, this system will be easy for you. Always, whatever that is coming in, that ins are debit, goes out. If something goes out, those outs are credit. All right. You will get this. You will get good at this when we move on, when we do some double entry accounts. So don't worry. Okay. It's natural to get a little confused at the beginning. It's natural. No worries. Okay. Moving on. And how the debits and credits are recorded. We have to learn that. Yeah. For sure, we have to get that. For sure. This is the date column, children. Narrow column, wide column. Again, a narrow column for ledger folio and a wide column for amount. Narrow column, wide column. Again, a narrow column for ledger folio and wide column for amount. Alright, this is the format of a ledger account, but the columns were not drawn. I drew the columns. I ruled the columns myself. Date column, description column, amount column. Again, date column, description column, amount column. Debit side, credit side. Debit side and credit side. Okay. Debit and credit. See how cash is recorded, the way cash is recorded and the way purchases is recorded. Let's take the debit entry first. What is coming into the business? Goods are coming into the business, right? Goods, stacks and stacks and stacks come in to the business. Stocks. Stacks of stock. Stacks of boxes filled with stock. We buy from our suppliers, so goods come in, stock come into the business. Ins are always debited. So debited not to stock account, not to stock account. All right, remember, this is a point to remember, children. Stocks or goods purchases are recorded in purchases account, not a stock account, not a goods account. Do not draw a goods account. Do not draw a goods account. Draw a purchases account instead. So purchases account, debit, because stocks are coming into the business. And cash are paid out. Cash paid out. Outs are credit. Debit the purchases account. Here you go. This is the purchases account. Debit purchases account. Debit side, all right. Debit side, see how it is recorded. The amount is 5,000. It is recorded here, and the date is also recorded. What about the description? That's something new. You're going to learn it now. Put in the description. Children, the description column should be filled. Oh, the details column should be filled compulsorily. It must be filled. Not only the amount, okay? Not only the amount, the details must be filled too. All right? So, we know that increasing or in, set in goes to the debit side, and we know that we don't draw a goods account or a stock account. We draw a purchases account instead. So purchases account, debit. There you go, the purchases account is here. And the debit side I have highlighted, see. Let's enter the amount to the debit side. Here, I entered to the debit side, amount. And the details column is blank now. Okay, I made it blank. How do you put the details? Children, details column should be filled with the name of the other account, which is the credit account. Details column, in details column, you mention the name of the other account, the second account. All right. So that is cash. That is the detail or description of purchases account. This account, description, cash. Then cash account, which is the other account. In cash account, the description is purchases. It comes from the debit account. Confusing? Is it confusing? Like I said, practice will make you perfect. Okay, we are going to do more transactions and enter them in accounts. No worries. Just for now, remember, the details column always, the details column is filled for every transaction with the name of the other account, and in the other account, the details column is filled with the name of this account. We just exchange the names. Okay, exchange the names. Right. All right. So the double entry is recorded. How many entries, children? One entry here. The other entry here. First entry in the debit side. Debit entry. Done. Second entry in the credit side. Credit side. Second entry goes to the credit side. Done. Date, details, amount, everything is recorded. Okay. That's it, children. End of story. That is recording the double entry of a transaction. Okay. Very nice. We'll directly go to an exercise. Here we go. The exercise, the activity which is in your textbook. Following are the transactions that occurred in a business during the month of March. Month of March, which year? Which year do you want? 2000? That's too far. 2020? Okay, 2020. Following are the transactions that occurred in business during the month of March 2020. Write the double entry of each transaction. Write the double entry. Now you just have to write. We will write. You will watch. No. That's not gonna happen. I'm gonna ask you. You decide the double entry and we'll discuss. Okay. Agreed? Okay, agreed. Let's do this. First transaction. Introduction of capital by the owner. 200,000. March 1st. Introduce capital by the owner. 200,000. Alright, now I'm going to give you all sorts of hand gestures, right? Introduce capital by the owner. Owner, that is me. Okay, you are the accountant of the business. Don't forget that. I bring in 200,000 from my pocket and I invest that 200,000 to the business. There you go. You got cash. You received cash. 200,000. What happens to the cash asset? Increases. Assets increase. Debit. Which account should be debited then? Well, look at the transaction. Which asset increased? Cash. Because cash is the asset which came into the business. From my pocket to business. To your hand. You are the business. You are inside the business, okay? I'm the owner. You got cash. So in the business, in your side, cash increased by 200,000. Increases of assets, debit. Which account should be debited? Cash account. That's right. Cash account. I'm going to use short forms ACC for account. Cash account should be debited. In the debit side, you should record 200,000. This 200,000 in the debit side of cash account. And what is the double entry? The double. I'm asking you for the next entry. You know that every transaction should have 2 entries. Tell me. The credit side entry. So to which account the credit side entry should go? The credit entry should go to which account? Capital account. That's right. Capital account should be credit. That is the double entry of this transaction. Now, children, since they have asked us to write the double entries of each transaction, we are going to write in words. But later, we are going to record in accounts. We are going to draw accounts and record. From the second transaction, I'm going to write the double entries below, okay, from the second transaction. Let's go straight to the second. Cash purchases 50,000. I told you purchases means purchasing goods, and goods coming into the business, goods coming into the business, okay. Ins are debit, outs are credit. So ins means goods according to this transaction, purchasing 50,000 of goods. Cash purchases means children purchasing goods, okay. Take it to your heads. Cash purchases means purchasing goods. So goods come in to the business. And you know that ins are debit. Which account should be debited? No. I told you that there is no goods account. Purchases account. That's right. Purchases account. Shall we write the answer here? Down, below. Purchases account. Debit. Then which account should be credit? Which account should be credit? You are purchasing for cash, right? What happens to your cash? Cash should be paid out. Cash goes out of the business. Because for the goods that you bought, more and more goods, more and more cash should be paid. Then cash decreases or cash out, outs are credit. Outs are credit, which means cash account is credit. Okay, I'm just going to do the third one. Rest is up to you. You're going to provide me answers. Third one. Okay, I'll take the third one here. Second one. Second one is here. Now I'm doing the third one in red. I'll do it here. Third one. Payment of monthly rent. We have paid rent. Paying rent means it's an expense. Money goes out. Outs are credit. I will write the credit entry first. Cash account, because cash goes out. Cash account credit. Cash account credit, because cash goes out. Which account debit? Well, how does it affect? How does this transaction affect the accounting equation? What is increasing and what is decreasing? Expenses increasing. More and more expenses you pay, expenses increase. And cash decrease. Decreasing cash is recorded because asset decreases are credit, or the other method, if you can remember, outs are credit, ins are debit. It's the same. And since the cash goes out of the business, it's credited. Cash account is credited. What comes into the business? Rent. No. Expenses add up. Expenses increase. Every month you pay rent. Every month the rent expenses increase. What I'm saying is, in your business, if you pay 1 month's rent, let's say it's 10,000 for the building, monthly rent. If you pay 1 month's rent, it's 10,000. But second month also, if you do business in the same building without moving into a own building, second month also you have to pay 10,000. Then the rent expense has added up to 20. Third month also you pay 10,000, 30. Fourth month also you pay 10,000, 40. Fifth month also you pay 50. Likewise, the whole year you have to pay 120,000. So as you pay expenses add up and expenses increase. And you know, expenses are coupled with assets in the same side. Just like assets increase debit, expenses increase also debit. So rent expense account, debit. Was it clear? That is the third one, children. Do you want me to do the fourth one? Then, like every time, I'll be doing all the exercises by myself. No, you have to do this exercise on your own. On your own. Like I said, practice. If you get any difficulties, any issues, take the help of your elder brothers, your sisters, your teacher in school, your business and accounting teacher, or any brother or sister you have, any cousin you have in your family who's doing maybe A-levels in commerce. Ask the double entry. They will tell you. And argue on your own. Argue, how did this come to the debit side? Why? Why did it come to the debit side? Rent expense account debit? Why? That's how you learn. Alright? Cash account credit. And why the cash account was credited? Why? Think. Thinking will provide answers. Thinking will give you answers. Okay, so recording of double entries. With that, children, we are going to wrap up this session. And the next session, we'll be doing some accounts, drawing accounts. It's called ruling accounts. We are going to prepare accounts and record the transactions in debits and credits of the account, ledger accounts. All right. Thank you for being with me. I hope to see you soon. Hope you will join the next session, which is the last session of this lesson, in which you will learn how to draw accounts with me. Thank you very much. See you soon.